we're at the upside of the daily range in crude oil and the upside of this week's range, both on just the second trading day of the week. And yeah, it's funny. That's what we're talking about here today is high commodities and a little bit of slow rate talk, with the backdrop being all the information that we do send to our subscribers. We're going to utilize some of it here. You get some of it for free, but if you want all of it on a weekly basis, join the community, subscribers.thesmallexchange.com. Talked about actually hedging, Pete, this week, and using the SM75 index, which is currently at an all-time high. Never a better price to hedge using the SM75 futures. So you can absolutely look into that this week's article here. Hedging, not the most fun process, but I mean, I just had a buddy ask me not even 2 weeks ago. He was like, hey, I've got, a couple thousand in technology stocks. It's gone way up in the last couple of years here. What do I do to take some of the profits off the table without getting rid of all my stocks?
Right.
That is where futures are spades, right, Pete?
Absolutely, because you know what? Small futures too. And we always emphasize this, but, even with a micro future, you're still managing $20,000, $22,000, $23,000 at a clip. Yeah. So for a lot of us, for the $25,000 portfolio, now we've got a binary decision. I either want it all off or I want it all on.
Yeah.
What I like to do, and whether that be finding better trade location around a directional idea or management of part of a position, smaller slices give me that. And that is what we're giving you here. It's the ability, and what you've walked through so well, is to manage a portion of your portfolio, to hedge a portion of your portfolio at these incredibly, are they lofty levels? Well, we'll find out today.
Yeah, we'll find out tomorrow
Yes.
if today was the most expensive. But either way, I mean, hedging isn't a process of like, I picked the high to hedge. It's just like, wow, this stuff has moved up 50% in the last year here. Maybe I'll take some profits off the table. And you nailed it, Pete. What's nice about the equity index futures at the small exchange, all of them are less than $10,000 in size. So you can have a portfolio of $6,000, $8,000, $10,000. Use one of these futures that only cost you about $500 or $600 to trade. Great, efficient, low cost to use the futures there. And you're not over hedged, like you said, with those micros. Is if I have less than $20,000 invested in the stock market and I use one micro, then now I'm actually short stocks. I'm over hedged. And so, yeah, nice flexibility, nice low cost, $0.5 or $600 to trade the sticks or the SM75. Could be a good time to hedge here as SM75 hits new highs, similar to commodities like oil and gold, Pete, back at their highs. But this is an interesting one. Oil, we're seeing this today where it is a rip through those highs. I mean, this is more than $1 move to the upside in SMO, a big move through the highs. Metal's a little different. It's kind of just like teetering at those highs. It's not, gold didn't go from 1850 to 1900 to 2000.
Right.
It just got up to 1900. It's kind of circling around there. What say you about commodities at these highs?
I think we were talking about this a little earlier. I'm not in a race. Selectively, things like corn that have had such dramatic moves and have given you what we wanted, to trade down from plus $7 to $6 in the matter of 3 days. A dollar move in corn, when we were selling 360 at 350 puts, we were hoping for a 20-cent move over the next month in corn. So back and forth there. Some of the gold, silver, crude, we liked to traded the range when we had it. It was 79 and a quarter in spree. It was really 67 and a half to 62 in crude. We're outside of both those ranges. Yeah. Now, what we like to do is trade the range until not us, but the market proves us wrong. Well, the market has proved us wrong. It's given us a lot of great back and forth. This is one where it's proved us wrong. I'm not in a rush to say, well, you know what? We're at slightly better levels. I want to go back and find that level. I think we're at a position possibly where we can expand those levels a little bit. Now, sometimes we just collapse right back into 79 for spree, 1850 for gold, $67 for crude, and
it's happened more often than not.
absolutely. But I would rather set this up for, let's see how the balance of the week shakes out. And maybe we get a new set of ranges, because we've symmetrically managed exposures, and we'll continue to do so. I know that sometimes I'm going to take stuff off at the highs. If it's a static delta directional trade, I've got no problem with that, because if you don't, you've eliminated any sort of mechanical statistical advantage you may have.
And it's funny because I actually I'm just writing about this for next week's edition of that subscriber newsletter, Pete, which is like, stuff is at extremes, but the ranges are getting compressed. And I would agree with you that this isn't like the type of move, especially in SPRE, in gold and silver, the metals futures there, where it's like, if I'm used to doing 3 contracts when they rip through the highs, I'm not just putting on 3 contracts because they are high, because there's not been reflexivity. They're inside a 30-cent range. There's nothing, there's no real like rush, like you said, to get them on. Now, that being said, I do like the idea of, if I'm used to doing 2 or 3 or 4 contracts, I'll put 1 on here in both the SMO and the SPRE, knowing that if I get the 69s in SMO and I put 1 on there, I can put 1 on at 70 and 1 on at 71. Right. And then I've got 3 contracts that are short at those higher prices. Mm-hmm. And the nice thing about that is, Pete, you're hoping to not get all 3 of those, because if you get the 69s, and even if you get the 70s and you don't get those 71s, that means that they've moved back in your favor. So I do agree with you that this isn't the type of market where it's like, I'm going with my full size and I'm going at it right now, even though it's all inside days. But you got to get something on here. And this has been the scenario where last time we were up here in metals, gold peaked its head above 1900, didn't rip higher. It stayed there, and then it came off. So you can't necessarily get completely scared away from the slow moves here, because we've seen the same thing in interest rates. When volatility calms down, Pete, and the ranges go from, we've seen SPRE go from a range of $1.25 to $1 to now below 80 cents on a daily basis. Similar in rates, most of these interest rate products here, the 2-year, the 10-year, and the 30-year, within 50 cents on a daily basis. You can't necessarily just take them off your screen, especially with that non-farm coming up.
No, absolutely. And I for me, the interesting, and this is what I love this. I can look at a page in 30 seconds, really intent. It's not being clever or anything else. Pull stuff out here. What's interesting, what's anomalous, is that the 30-year is moving less than the 10 or so right now. Yeah. It's an interesting aside. Traditionally, Frank's professional interest rate trader for a number of years. We always know that the longer duration interest rates typically have higher beta. So they tend to move more. Not in this case, which is talking about the long end of the curve just not being as interesting as the belly or middle of the curve, which is where the 10 years are. Absolutely right. Would we expect this kind of, we talked about this yesterday, sometimes we get a little bit of a creeper into rates ahead of a non-farm. It seems like we're going in very much kind of a centered market, and we'll see what the market gives us. And we'll look for some setups tomorrow. We'll talk about on Thursday, and then see what we could get into Friday on that 730 number.
Yeah, on Friday, I will definitely be looking at that 10-year specifically for the biggest moves and where I'm looking for reflexive action. Like, that's where, if rates are moving around, I would expect that 10-year to continue to move the most and give a lot of back and forth. Right. You and Jamal looked at it yesterday, the last non-farm, you saw that 10-year whip around a good amount. Now, that being said, I don't mind lining up my interest rate opinions in the 2-year, which has become very, very calm, knowing that I've got a quarter of the risk, historically speaking, in that 2-year relative to the 10-year. So if I want to go in to Friday being long yields, I'm going with that S2Y for sure, knowing that even on a big day, it's only moving $20, $30 historically, a lot less than that 10-year, which can move up to $100, $150 on the big days there. So I'd go to the S2Y for my yield opinions going into what'll be an interesting non-farm early Friday morning. So make sure you get your trades in going in there. But S10Y is what I'm looking at during the event itself, because that'll have a lot of whip back and forth. Now, Pete, something that not necessarily had a lot of whip back and forth, but has created a lot of intrigue for us historically, and I think is creating some intrigue right now. Look at this US dollar and Japanese yen chart, Pete, and keep in mind that the red line SFX, one of its biggest counter components is the yen.
Right.
And so rarely do you see two markets that have trended to their lows together when one is partially at odds with the other, but you've got SFX at the low with Japanese yen. Does this look like a long, long pair trade to you or what?
A part of me is from the extreme. Absolutely. If you want to take that yen piece out, really for me, and I've said this before, when we have just dollar moves, the yen kind of just muddles. We up near 4-year highs at 142.5 in sterling, euro 122. The yen tends to not do much. So that means to me, and it's just kind of what I've felt and seen over 20 years of trading it, which means it trades the range. Now we're at the bottom end of the range, so that becomes an interesting trade for me. I think that I actually like that. And again, Frankie, when we're doing a buy pair trade here with a currency and the dollar index, we're not Texas hedging ourselves, so to speak.
Yeah.
It's a different type of trade because of the inverse relationship of the two. Can you, because I will give the 30-minute diatribe, can you give us the 30-second one?
Well, yeah, just that when you are looking at currencies, you're always looking at them relative to something else. They're an asset class that has to be measured in the same way that gold, primarily for our purposes, is measured in US dollars. When we're looking at yen, it's measured in US dollars. And when we're looking at US dollars, in this case, it's measured in yen, euros, Chinese renminbi, and so on, a few other currencies there. So that being said, they are negatively correlated historically. And thus, when you're buying both or selling both, that's a hedged up pairs trade. And so this long, long trade, both of them at their lows, is in theory a hedged pairs trade, as opposed to it's not the same as oh, I'm buying Amazon and buying Microsoft. Right. No, those things are highly correlated. So you're going to either be really right or really wrong. This is still a pairs trade. And Pete, maybe you can conclude with this, the fact that the long yen piece is a little bit of a long volatility play historically. Agreed. Right?
Good point. Absolutely. Yen is, and I don't even want to go through the diatribe, but the yen traditionally is a little bit of a long yen piece is a vol substitution piece. In other words, you tend to see yen bounce when volatility expands a little bit. And that's equity volatility. So it is a little bit of synthetic long vol, which we don't have a lot of here. So I think that I'm glad you mentioned that, because it absolutely does. It does fit that piece. So it's got a couple of different uses for us within our portfolio. So it's a great way to absolutely break that down.
Yeah, and that's nice that the SFX is a one-to-one trade with that micro yen. And so that'll do it for today's small stakes, everybody. Thanks so much for joining me, Pete. You're the best as always, and you're going to be the best on the next show, Splash into Futures, coming up right after this. Stick around. We do have some trades that we want to get going in the trading platform. It looks like a slow one, but there's some underrated stuff to get done there. Got to stay active. You can't just shut down the platform on inside days, right, Pete? So
absolutely.
We will get in there and get some trades going. Hang around for Splash into Futures coming up next. Thanks, everybody.